On a day when the ASX 200 dropped 1.1%, the market's attention went where it always does: iron ore, oil, and Middle East tensions. BHP fell 3%. Fortescue followed. The narrative wrote itself. But while the mining sector absorbed the headlines, a quieter escalation arrived that carries a different order of consequence. Meta formally accused Australia of breaching the 2004 Australia-United States Free Trade Agreement. Not complaining to a regulator, not threatening to pull a news tab, invoking a treaty. The trigger is the news bargaining incentive, draft legislation that would impose a 2.25% levy on the entire Australian revenue of Meta, Google, and TikTok if those companies fail to strike commercial deals with local news publishers. The government's own estimate puts the annual value of those deals at around $250 million. Meta's response was unambiguous. It is a discriminatory tax, applied only to a handful of foreign companies. The company called it economically incoherent and vehemently opposed the legislation. 2 U.S. lobbying groups filed separate submissions last week, both arguing the incentive violates the free trade agreement by targeting only American companies. That is no longer a private complaint. It is the formal legal framing the Trump administration would need to escalate. And in a year when Washington has already used tariff threats to reshape bilateral relationships across the Pacific, the timing matters. The context layer running underneath all of this is IREN's announcement from Wednesday night. A NASDAQ-listed, Sydney-founded data center operator has signed a transmission connection agreement to build an 800-megawatt AI campus in Bunday, South Australia, the country's first large-scale AI infrastructure investment, and the first in the world anchored entirely to a renewable-only grid. The local mayor is, as Capital Brief reported, ecstatic, but IREN's decision to land in South Australia was not accidental. It came after months of regulatory negotiation with a state government that, as the company put it, understands the opportunity and is acting on it. That contrast, a state government accelerating AI infrastructure while the federal government advances a levy specifically targeting U.S. digital platforms, is the frame that domestic capital has not yet reconciled.
Australia has been here before. In 2021, Meta blocked news on Australian Facebook for 3 days before reaching commercial deals under the original News Media Bargaining Code. The market read that episode as resolved. The government read it as a template. What changed is the legal instrument. The original bargaining code operated under domestic competition law. The news bargaining incentive introduces a 2.25% revenue levy as the default if deals are not struck, and applies it to total Australian revenue, not just revenue attributable to news. Meta's statement specifically flags this. The levy is broader than digital services taxes in other jurisdictions, some of which have already drawn U.S. trade responses. That framing is not rhetorical. The 2004 Free Trade Agreement contains a national treatment clause requiring that U.S. companies not face less favorable conditions than equivalent Australian competitors. A levy applied only to 3 named U.S. platforms, with no equivalent obligation on domestic social media operators, is precisely the legal structure a national treatment challenge would target. The unstated premise in the government's position is that the FTA clause does not apply because the levy is designed as a journalism funding mechanism rather than a trade barrier. That premise has not been tested. It requires the conclusion that purpose overrides form, a contested reading in trade law, and one that the U.S. Trade Representative has previously rejected in analogous European digital services tax disputes. The market premise running the other direction is that Australia simply settles again, as it did in 2021. That is possible, but the conditions are different. In 2021, the Trump administration had just left office, and the bilateral relationship was operating in a low-friction mode. Now, with a second Trump administration actively using trade tools and U.S. tech lobby groups formally invoking FTA language, the probability of quiet resolution is lower than the 2021 analogy implies. What this means for positioning is not yet priced into ASX-listed media assets. The news bargaining incentive is designed to direct levy proceeds to domestic news publishers, 9 Entertainment, News Corp Australia, 7 West Media, and smaller independents. If the legislation passes without triggering trade retaliation, those companies gain a funding floor. If the FTA challenge succeeds, or if the U.S. escalates to a retaliatory tariff structure, the levy does not proceed and the funding floor disappears. A media asset priced on the assumption the levy passes is carrying trade law risk it is not discounting. The second-order path is less visible. IREN's 800-megawatt commitment is the largest announced AI infrastructure investment in Australian history. The company cited South Australia's renewable grid and state-level regulatory cooperation as the deciding factors. But IREN is a U.S.-listed company, and its investment thesis depends on a stable bilateral technology investment environment. If the NBI dispute accelerates into formal trade framework friction, the risk premium on future AI infrastructure deals rises, not for Iran's existing commitment, but for the pipeline behind it.
The unresolved question from the mechanism layer is this: whether Australia's regulatory posture, one that accelerates foreign AI infrastructure on one hand, while imposing platform levies with treaty implications on the other, can hold both positions simultaneously without capital costs. The 2021 parallel is the market's working assumption. Under that scenario, Meta and Google reach commercial deals with major publishers before the levy takes effect. The legislation passes but is never triggered, and the FTA challenge is withdrawn. The outcome for media stocks is a soft funding floor, and Iran's infrastructure investment proceeds without a trade friction headwind. For that scenario to hold, Meta would need to reverse its stated position. It has called the law poorly designed and grossly unfair, and the U.S. administration would need to treat the FTA invocation as a private negotiating move rather than a formal escalation. Neither is impossible. Both require a climb down that is harder to execute in June 2026 than it was in February 2021. The verification point is the parliamentary calendar. The legislation is due to be introduced into Parliament later this year. The government has not set a precise date. Ahead of that introduction, watch whether the U.S. Trade Representative formally engages the FTA mechanism. If the USTR files a consultation request under the agreement, the settlement by deal scenario becomes structurally constrained. The dispute exits the bilateral corporate negotiation track and enters a government-to-government channel that neither side controls on its own timeline. On the ASX, the two positions that carry asymmetric exposure are domestic legacy media, Nine Entertainment, News Corp Australia, and Australian operations of U.S. platform-adjacent services. If the levy passes, media stocks gain a structural revenue floor. If the FTA challenge escalates, that floor is removed before it is built. The current pricing implies the levy passes. That implies the unstated premise that purpose overrides form in the FTA national treatment analysis holds. What would prove that wrong is not just a U.S. complaint, but a formal USTR consultation notice, which would be publicly filed and observable. Until that filing either arrives or does not, the capital sitting in domestic media assets is pricing one side of a two-outcome legal question as resolved. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.